But one farmer says, seems to me there was a tea party in Boston that was illegal too.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
We shall seek to establish and maintain a dollar which will not change its purchasing and debt-paying power during the succeeding generation.
As anguished shrieks rose up from the floor of the New York Stock Exchange.
Government credit and government currency are really one and the same thing. A reserve of gold and a small reserve of silver.
Why do central banks hold it?
Well, it's a form of reserves.
Why don't they hold diamonds?
Well, it's tradition, long-term tradition.
Well, some people still think it's money.
Showed the Dow plunging 450 points with the bell open. When it opened up, I think it was down about 600, then it went down to 800. It's been fluctuating. Currently, it's around 500. The point is, it opened up this morning, and of course, the Dow falling. It bounced slightly. However, it is apparently around the correction level now, about 10%. So, welcome back here to the Junius Maltby channel for what's likely going to be a lengthy installment because we are going to talk about gold price manipulation. We spent time in the past discussing spoofing, the JP Morgan scandal, the arrests and imprisonment of those responsible for manipulating the silver price. We've got a great read today to go through by Jim Rickards. The name should be familiar and ring a bell with all of you. Kind of a titan with the information that comes in about gold. He's got a lot of contacts, a lot of connections out there in that world and is able to produce quite reliable and controversial information. He's kind of like a walking WikiLeaks for gold news sometimes. Just a good piece of information. We'll go over that. And we'll take a look at, of course, the Dow. We'll take a look at gold and silver briefly. Talk about some of those price points, where they are performing on the year. And big shout out. Welcome to the channel, the lurkers and creepers, and those who like to just check in to see what's going on. Break out your favorite flavored crayon. Make sure you take some notes. You might learn a thing or two. Glad you can be here and give us some views. If this video happens to hurt your feelings, or even my welcoming gesture just now hurt your feelings and gets your panties in a twist, I apologize. It's unfortunate that you don't have the fortitude and your mother didn't raise you to be a stronger person. That's unfortunate. But again, you're here, so you're making progress. You're sitting on the Junius Maltby channel because you've got nothing better to do than to tune in to the most boring channel on YouTube. Oh, one of these days we'll have to give them just a real hearty welcome. Well, glad you're here. Anyways, we've got the Dow down 508.84, almost 2%. So we had a 3.5% plunge, a 3.5% plunge. It was 7, we're at 8, 9. It was touching on 10% earlier, but yeah, we're sitting about 9% down from its high there, sitting at 26,448. We'll look at the overall performance here in a moment, but that's just a pretty gruesome chart for the month. You can see it just diving off there ever since everyone began panicking over this. What do they call it now? The Wuhan flu, the Wu-Tang flu, the Kung Fu flu, COVID-19, whatever. Bring it on. It's the earth shaking off her fleas, and it's kind of welcome, I guess, huh? Here's a pretty gruesome chart. Again, the Dow, but look at that 6-month chart. Just dropping off a cliff there. What's really funny is when you overlay this over a 6-month or a 1-year gold chart and you just kind of line them up together and you see there's just the performance difference. Of course, again, gold doesn't pay you a dividend. We all know the story there. That's not the part of this video where we've talked about that enough in the past. The point of that is hedging, safety, wealth preservation. A lot of people ignore it and to their own detriment. The best time to, people should have done that flip. We talked about that, the Dow gold ratio and making that leap when the Dow reaches those record highs. And it would have been a good time to do so. I think this correction is not going to slow down. I don't believe. I think the more you look at it, even without this Kung Fu flu as a factor, we were already facing the longest bull run in history, really. It was unprecedented bullish activity. And you all know the reasons for that. The repo market bailouts, quantitative easing times infinity, the artificially suppressed and low manipulated interest rates by the Fed, easy credit, increasing speculation in equity markets and such, also in real estate, everything, just feeding off the teat that is the fiat empire. So with that in mind, now they introduce this little cough from the eastern part of the world, and now everyone's freaking out, putting masks on, and disrupting travel, commerce, and trade. Fear bleeding into the markets. We're seeing that now. So even without that, like I just said, we were already facing an impending correction. We talked about that at length, and recessionary events taking place, liquidity problems in the repo markets requiring Fed intervention. So now you have this, and they were trying to stave off these types of plunges before. Now that's why I have the theory that perhaps they're putting a little bit more emphasis on the Kung Fu flu than there should be. I think that it might be a microscopic scapegoat, because the virus can't defend itself and say, hey man, I didn't do this. It's not me, it's you guys. You guys wrecked the economy. So it's a really good little thing to place the blame on when it can't talk back. You know what I'm saying? So that's kind of a side theory on the whole thing. And there's other people that share it as well, that believe there's an overemphasis on what the COVID-19 is actually going to do and could do to the global economy. Yeah, and I'm not trying to downplay it. I know there's problems with it. I know viruses are extremely dangerous, and I'm just curious how much of this is media hype as well. If you've been part of the channel for any length of time, you know the correlation between oil price, gold price, and the dollar. Kind of a trifecta there, how they kind of all bounce off each other, especially that linkage between oil and gold, being that gold production and extraction is often heavily tied to the price of oil, because the amount of diesel and oil that is required to get that gold out of the ground. And we've gone into that. We've done some videos talking about that. We've talked about the all-inclusive costs per ounce sold and the breakdown there. A lot of times, I believe, when gold was hanging out around 14 or 1500 back a few years back, even 1100, you saw numbers where the requirement to produce an ounce of gold in oil, just the amount of, diesel, the amount of diesel that it took was around $700 approximate. That again fluctuates by region, by mining operation, and locale, just because of the fuel cost differences in different parts of the globe. And you'll see disagreement on what the number really is, on how much the cost of diesel, how much diesel it takes to get an ounce of gold out of the ground. And I've seen it everywhere from $300 to $750, depends on what paper you read, what mine report, and all that stuff. The point is, they're linked together. What's interesting here is we saw oil drop, and oil's been really struggling. It's been getting beat up quite a bit recently. And seeing oil drop more than 5%, and it broke below that $46 mark as the, quote, collapse continues. And what's interesting is gold didn't really follow it a whole lot. Gold's in a rebound today. We'll see that price here in just a moment. We'll talk about the gold price. But I wanted to bring this up because we kind of tend to forget and not talk about oil a whole lot. The dollar also down. Dollar's down about 98 points right now, 98 basis points, sitting hanging around there. And I really don't care what the dollar is, because it really doesn't have any value at all. It's just, the leper with the most fingers left there on the forex market and of all the currencies. But it's only used because you're forced to use it, right? You guys know how it works. But there you go. Oil dropping 5%. So interesting for those who are exposed to the oil markets. Here, let's take a look at the gold COMEX. Up 1350 this morning, 0.82%, 1656. So really healthy, sitting in the mid-16 range. We blew past 16, a number that most people didn't really think would be attainable this early in the year. But it is there. It is above 16. I believe it's going to sit there and close the year out well above 16. As a matter of fact, we'll see some headlines here that point to $2,000 gold. We've talked about that. $2,500 gold, possible. Very low. I mean, it's in the books. It could happen. June, look at that low down there. I mean, you remember when we were sitting there below 1,300 in the 12 range? And even though if you look at the last several years, we did the video already on where are the gold bears now, where have the gold bears gone, where's, paging Harry Dent. Where is he at? What's he doing these days? I've heard he ran away from his gold theories, but we had a lot of calls for gold to plunge below the $700, the $500 range, And definitely you saw I mean, it was easy for people to call it to go below 1,000. And then we all here, the position of this channel was that's not going to happen. We looked at the big central bank buys, the India buys, what took place post 2008, and it was very unlikely for gold to fall below 1,000, and in my opinion, ever again. I don't think you will see gold under 1,000 in your lifetime or ever, unless they, of course, restructure and somehow peg the dollar to gold. This 1656 marks good. It's strong. It's healthy. It's definitely a validation and a vindication for those who've been holding it and stockpiling and stacking gold. Those of you who are fortunate and have the means to do so. I know it's difficult. I know it's hard. I know for a lot of people, just getting a 10th ounce of gold is a big deal. And to those of you who've purchased your first gold this year and made that leap, congrats. Tip of the hat to you. You're doing good. Again, this is this morning. These prices are going to change. It hasn't closed yet. This is about 5-10 minutes ago. And if you look there, I want you to check out the 1 year percentage change. We'll take a look at two of the things here, 1 year and then the year to date. The 1 year, so from a year ago, gold's up 21.93%. We're sitting at almost 22%, ladies and gentlemen. Okay, we got the Dow. We're going to take a look at that here in a minute. But remember that, up 22%. Year to date, so from January 1, we're only 2 months into this year. And for the year to date, we got an 8.54%. Gold could stagnate for the rest of the year, not move a single penny, and we would close out up 8.54%, which is better than a lot of years for a lot of other assets and vehicles that people put their money into. So 8.54%, keep that in mind. It's probably going to close higher than that. I mean, we could be looking at one of those years, as we've seen on those multi-decade graphs and charts, where gold can do anything from 20 to 30% in a year. So we could see that happening. And the Roomba is coming by the room, so you might hear her buzzing and humming. My little robot slave. And stopping in to check out Silver, our little crippled kid with the crutches, getting butt kicked again. Silver, what are you doing? What are you doing, Silver market? It fell below 18 again. And I brought this up. I don't understand it. Silver has so many medicinal properties to it. It's in salves and ointments, and the medical world uses it. And you'd think with the burden on the medical world at this point, and being that silver has these properties that are not only antibacterial, but it's used in hospitals. It has those applications. You'd think that there would be some kind of an increased demand for it. I saw a headline earlier when I was going through this that the silver market's overbought, and they're looking for it to decline even further. So again, silver is just the volatility of the silver chart, the price fluctuations, its inability to remain above $18 an ounce. It's kind of disheartening. And I know there's a morale problem among the silver holders. Some of you, anyway. Some of you keep the faith no matter what. I applaud that. But this will lift your chin up just a little bit. In spite of this decline and this inability to hold $18 right now, it's up 2 cents today. 0.15%. Not a big deal. Again, the markets are still open. But look at the 1 year percentage change. So from a year ago today, it's up 9.98%. So I'll take that. 10% on a year. That's not bad, not bad. And you look at the year to date, however, so going back to just January 1, 2020, it's down 1/3%. Pretty flat. Year's not over. Got a couple months left. 10 months left this year. So silver might surprise us. It could do something. It could pull a fast one. Keep your eye on it. We'll keep talking about it. I'm sure you'll stop by here at some point again when you're feeling like you need some boredom. And we'll check on the silver chart. But for now, that's what you see. Now this is the Dow again. We're going to revisit it because we just looked at gold and silver's performance in percentage over the last year and the year-to-date change. Okay, so the Dow is down year-to-date 7.74%. So from January to now, 7.74%. Apparently it touched on almost 10% at some point when the numbers were at their lows today. You can already see the change there from when we opened the video to when this screenshot was grabbed. So at this point, it was 473.66. And at some point while we're making the video, I'll check in again. I'll look at the Dow and we'll kind of refresh the numbers. We'll talk about it again. We'll revisit them. 1 year percent change. So from a year ago, up 1.32%. So essentially, almost an entire year's worth of gains have been wiped off the books. Brings us to the point that Goldman Sachs today, I think it was Goldman, right? Because I did not put the article in here. I just read it, skimmed it, cataloged it, and bookmarked it in the old brain there. They said look for zero gains for the year because of COVID-19 Kung Fu flu. They're saying because of this flu and what's going on in the economy that there will be no gains. We're looking at 0, 0, and 0 across the board for the equity markets here. And that was just something that Goldman touched on. Again, I didn't dive into it. It didn't pertain to me. I don't have exposure there, so I don't care. It's just something to report on and discuss, as you know. But that's definitely going to raise the hairs on the back of the necks of some of the guys in the little blue schmucks with the numbers on their tag vests on the old floor there at Wall Street, shouting and screaming at one another and waving their hands about, gesticulating for price movement. So those guys are probably going to take that to heart, and that might be a reason why we are seeing some of the performance that we're seeing today up on the boards. All right, kids, put your water wings on because we're going to dive into the gold pool now and discuss some gold news. Near record gold prices supported by FOMO, for those of you new here, or the lurkers, creepers, and spies, those who like to stop by the video but don't know anything about what we are talking about. FOMO stands for fear of missing out, as equity rout worsens with COVID-19. And again, COVID-19 is code for Kung Fu flu. Gold prices push higher as the world stock market sank yet again on Thursday, edging up to show a $10 gain for the week so far in dollar terms as money managers ran further into the, quote, safety of government debt amid the worsening spread of novel coronavirus worldwide, with the MSCI World Index already down 7.1% from its new record peak of just early last week. Gold bullion traded at $16.53 per ounce as New York's Dow Jones opened the day 500 points lower. 10-year U.S. Treasury yields meantime fell to new all-time lows, offering just 1.26% per annum as investor demand drove bond prices higher. Enough of that. Let's move on. Why the Fed can't defend the economy against the coronavirus outbreak? Well, because the Fed doesn't have the antiviral capabilities. I'm sorry. They might be omnipotent, they believe, but they don't have the ability to corral a virus. It's just not in their scope of practice, if you know what I mean, to borrow a medical term. They can't do anything about it. Who cares? And good. I wouldn't want them to have the ability to do anything about it. The Fed shouldn't have the ability to really do anything. They shouldn't even exist as an entity, right? And the Fed. Federal Reserve is neither government nor a bank. It's just a bunch of private guys that issue paper and debt. Cross-border. Gold could test $2,000 on Fed, People's Bank of China monetary policy. Gold could test $2,000 an ounce in the year ahead on further loosening of monetary policy by the U.S. Federal Reserve and People's Bank of China, said cross-border capital. The Kung Fu flu is impacting global economic growth, with Chinese data showing use of public transportation has fallen by 80%. The People's Bank of China has made limited financial injections but expect more, cross-border said. And if you saw the news earlier in the week, China burned a lot of fiat. They piled all the paper up because they know it's not worth anything, but apparently paper fiat carries disease. Makes sense, right? So they burned a lot of their cash holdings. They'll just print more. Very easy to do. But they burned it. They burned it all up. Lit a big bonfire. Meanwhile, the Fed is expected to continue expanding its balance sheet. The firm said periods of strong liquidity injections. I love the way they use those terms. Periods of strong liquidity injections are often associated with a rising price in gold. Rising gold price. Of course, it's more units of exchange, units of account, chasing a fixed supply of a commodity. Simple economics. Gold, much more than many other assets, benefits from buoyant central bank liquidity. Both Fed and People's Bank of China actions matter, the firm continued. It would seem that gold could easily retest $2,000 an ounce over the next 12 months, Cross-border said. Moreover, its gains do not depend on a weak dollar. In fact, Looking ahead, we see the U.S. unit broadly stable. Gold looks set to rise against most currencies. We've talked about that. We've shown the charts. Gold does, is, and will continue to rise against all currencies on the market. It's just the way things work. It actually has been breaking records in almost every currency around the world. And just to point out, that's not the only article talking about it, and there's even more than this. However, there is a lot of institutions and firms that are pointing out that gold will likely hit $2,000 an ounce. It's nice to see that theme being discussed, because before we entered this year, really the highs I was seeing discussed and talked about, articles written about, and so on, were really around 1650, 1600. Some of the highest numbers I think we saw were 1700 discussed. Well, that all changed when we entered the year. Gold rocketed through everything, kissed 1600, now sits well above 1600, almost kissing 1700 just the other day. So now 2000 is looking much more attainable. And of course, we're seeing the news generated, the discussions generated, and it looks like a lot of people are just accepting the fact, even major mainstream firms, that gold will touch and sit at 2,000 by the year's close. Once that happens, I think the psychological effect that will have on people will really solidify gold's place in that area, in that arena, in that value. And I could see the FOMO kicking even harder, and we could see its chart almost palladium-like as far as what we've seen, that really steep uptick, hockey stick curve, that parabolic rise. With the economy contracting, if you see people starting to jump ship from palladium, depending what happens there, and the platinum family group metals, you could really see gold just very buoyant. You know, it's that beach ball held underwater thing we talk about. And of course, you know, its crippled little brother silver is going to be holding on to its coattails and riding up with it. So we should see silver at least perform a little bit. I mean, come on, break above 18, maybe enter the 20 range for once again. Gold ETF holdings hit record high amid Kung Fu flu worries. Gold-backed ETFs have never seen inflows like this. Again, the headlines are out there, ladies and gentlemen. Global investors are stashing more and more assets into gold as the Kung Fu flu outbreak spreads and appetite for risk takes a hit. The robot slave is swinging by. That's the humming sound you hear in the background. The global tally of bullion and exchange-traded funds swelled by the most in more than a month on Tuesday as equities sank. That was the 25th consecutive day of inflows, a record at 2,624.7 tons. The holdings are the largest ever. Wouldn't you think that would make bigger news than just being buried on GATA's site? You'd think it'd be somewhere in CNBC, but it is not. And this is keep these numbers in mind and this little headline here when we go and read Jim Rickard's article in just a moment, talking about gold manipulation. You guys got to get a Roomba. I don't really care if it's, you know, mapping out my house all the time. I think it's kind of funny. But probably the best little device I ever bought, because it just goes around and vacuums everything up. Vacuums everything up. No problems whatsoever. This not sponsored by Roomba. They have no idea who I am, so that was not like an ad placement. I think they're cool. I like Roombas and I like apple cinnamon flavored Cheerios. Again, not an ad, just my personal opinion. Craig Hemke at Sprott Money. U.S. real rates are already negative and will get more so, boosting gold. Yes, once those rates go negative, as Trump wants them to, as well the other interest rates we're talking about, combined with this, you know, gold's again. It's going to be buoyant. It's going to continue the trajectory that we have been seeing. So we are now 24 minutes into the video. At this point, we've most likely lost the booger eaters, the crayon eaters, and the very lesser interested creepers and lurkers who just swing by the channel to kind of see what we're up to. Because there are those out there, and they like to come by this channel and get their little feelings hurt. So hopefully they're gone. Or maybe they stuck around and they want to learn a thing or two. So how gold is manipulated. Is there gold price manipulation going on? Absolutely. There's no question about it. That's not just an opinion. There is hard statistical evidence to make the case, in addition to anecdotal evidence and forensic evidence. The evidence is very clear, in fact. I've spoken to members of Congress. I've spoken to people in the intelligence community, in the defense community, very senior people at the IMF, for the booger eaters, that's International Monetary Fund, I don't believe in making strong claims without strong evidence. I feel the same way. And the evidence is all there. You got to make sure you have evidence. Evidence is very important. If you're going to make an accusation, you better have strong, solid evidence. You don't just want to run around rambling and knocking on doors and tattletelling on people if you don't have evidence. Well, Jim Rickards has some evidence, so let's take a look at his case here. I spoke to a PhD statistician who works for one of the biggest hedge funds in the world. I can't mention the fund's name. You don't want to mention names, Jim. That's good, because you don't want to get accused of anything. I tend to do that often. When I'm recounting stories on here or doing things on the Junius Maltby channel, it's very good to keep a secret of locations, locales. You don't want to name any group or entity or agencies, anything like that that would cause an issue. So it's good to be anonymous and not mention things specifically. It's very important, and I'm glad Jim's sticking by that as well. So again, he spoke to this PhD statistician, big hedge fund in the world, can't mention the fund's name, but it's a household name. We can only guess. You've probably heard of it. He looked at COMEX, the primary market for gold, opening prices at COMEX closing prices for a 10-year period. He was dumbfounded. He said it is the most blatant case of manipulation he had ever seen. He said if you went into the aftermarket, bought after the close, and sold before the opening every day, you would make risk-free profits. He said statistically that's impossible unless there's manipulation occurring. I also spoke to Professor Rosa Abrantes-Metz at the New York University Stern School of Business. She is the leading expert on gold price manipulation. She has actually testified in gold manipulation cases. I think there was a spelling error there, ladies and gentlemen. I think he meant gold, not globe. I don't think anyone's manipulated the price of the earth, of the globe. If they could, they would, of course. She wrote a report reaching the same conclusions. It's not just an opinion. It's not just a deep, dark conspiracy theory. Here's a PhD statistician and a prominent market expert lawyer, expert witness in litigation qualified by the courts, who independently reached the same conclusion. How do these manipulations occur? Tell me, Jim. I'm very interested. Currently, the price of gold is set in two places. One is the London spot market, controlled by 6 big banks, including Goldman Sachs and JP Morgan. You know how that works. We've talked about the 3 phone calls a day or whatever between these guys. The other is the New York Gold Futures Market, controlled by COMEX, which is governed by its big clearing members, also including major Western banks. In effect, pause. Again, the archaic barbarous relic. We've heard how they only hold it out of, quote, they think tradition, right? I don't know, tradition. Benjamin Bernanke likes to say. But these are some big institutions. They spend a lot of time, energy, and effort controlling the price of gold, and there's a reason for it. Because they know its true value. They know it is the ultimate extinguisher of debt, the ultimate form of money, the ultimate credit. These are the genetic strain, or the heirs of those like J.P. Morgan. And we know what his feelings were and what he stated about gold. Remember, Alan Greenspan's 1966 paper on gold, what he said about it. They know. In effect, the big Western banks have a monopoly on gold prices, even if they do not have a monopoly on physical gold. The easiest way to perform paper manipulation is through COMEX futures. Rigging futures markets is child's play. You just wait until a little bit before the close and put in a massive sell order. By doing this, you scare the other side of the market into lowering their bid price. They back away. It's like a poker game, ladies and gentlemen. That lower price then gets trumpeted around the world as the quote price of gold, discouraging investors and hurting sentiment. Think of how many people have lost positions, taken losses, wealth. I mean, these institutions that manipulate these prices and do this, do so at the cost of real people. All right? It doesn't come without damage that is done to others. There's a real cost to this type of activity. And of course, they're not punished for it. There's no consequence. They just do what they do because they are, in their own mind, almighty. And in a way they are. They're untouchable. They're untouchable. The price decline spooks hedge funds into dumping more gold as they hit stop-loss limits on their positions. Now, one day these activities aren't going to work because I don't think the other side's going to get bluffed out of position. And that's the day we all wait for, is the day they try to do this and it doesn't work. However, at this point, it's continuing to work for them. So again, the stop-loss limits on their positions, a self-fulfilling momentum is established where selling begets more selling, and the price spirals down for no particular reason except that someone wanted it that way. Eventually, a bottom is established and buyers step in, but by then the damage is done. Futures have a huge amount of leverage that can easily reach 20 to 1. For $10 million of cash margin, I can sell $200 million of paper gold. Are you kidding me? Oh my gosh. That is, again, we've talked about the whole paper gold thing. This is what we're talking about. This is why physical is it. The more physical you can take off the market, the less these bastards can manipulate it. Oh, it's in a bad word. I must have hurt somebody's feelings. Shut the hell up. Get the hell out of here. Hedge funds are now large players in the gold market. To a hedge fund, gold may be an interesting market in which to deploy its trading style. To them, gold is just another tradable commodity. It could just as well be coffee beans, soybeans, treasury bonds, or any other traded good. Hedge funds use what are called stop-loss limits. When they establish a trading position, they set a maximum amount they are willing to lose before they get out. Once that limit is reached, they automatically sell the position regardless of their long-term view of the metal. Perhaps they don't even have a long-term view, just a short-term trading perspective. If a particular hedge fund wants to manipulate the price of gold, or the gold market, from the short side, all it has to do is throw in a large sell order, push gold down a certain amount, and once it hits that amount, these stops are triggered at the funds that are long gold. Once one hedge fund hits a stop-loss price, that hedge fund automatically sells. That drives the price down even more, and a lot of times it's automated. This is in computers. The next hedge fund hits its stop-loss, then it sells also, driving the price down again. Selling gathers momentum, and soon everyone is selling. And when that happens, you want to be buying. Another way to manipulate the price is through gold leasing and unallocated forwards. Unallocated is one of those buzzwords in the gold market. When most large gold buyers want to buy physical gold, they'll call JP Morgan Chase, HSBC, Citibank, or one of the large gold dealers. They'll put an order for, say, $5 million worth of gold. The bank will say, fine, send us your money for the gold and we'll offer you a written contract in a standard form. Yet if you read the contract, it says you own gold on an, quote, unallocated basis. That means you don't have designated bars. Remember how we've talked about this in the past? You don't own it. If you don't have the physical, you have something on paper, you do not truly own the gold. There's no group of gold bars that have your name on them or specific gold bar serial numbers that are registered to you. This is not vaulted physical gold that is yours to possess. In practice, unallocated gold allows the bank to sell the same physical gold 10 times to 10 different buyers. Over 10 different buyers. Remember years ago, the little picture I drew for you guys? The gold bar in the middle of a room, and around it are one-way windows. And everyone looking in that room at the gold bar in the middle of it thinks that they own it because someone else told them. The ETF guy, the paper guy, says, that's your bar. Here's a piece of paper. Here's your piece of paper that says you own that bar of gold. Well, the problem is there's not only 4, there's a multitude now. Over 10 different people looking in the windows, believing that the gold bar in the middle of the room belongs to them. They're selling more gold that actually exists. It's no different from any other kind of fractional reserve banking. Banks never have as much cash on hand as they do deposits. Heck, there's not even as many dollars printed and in circulation as they have on the books. You know that. If you look at how many physical paper dollars are out there in circulation compared to how many are digitized and exist only in accounts or on screens. If everybody said they wanted their physical paper, as I don't know who would, their garbage trash fiat that's impregnated with feces and cocaine. If you wanted your paper dollars, they don't have them all printed out there. They don't even have that many. So think of that, however, with gold now. It's no different with fractional reserve banking. Banks never have as much cash in hand as they do deposits. Every depositor in a bank thinks they can just walk in and get cash whenever they want. This happened to me once. I've told the story here before. I did a large withdrawal many years ago, and the bank did not have the cash. And I'm not even a big guy. I'm not a big heavy hitter. I wanted to get an X amount of dollars. Bank didn't have it. They had to call one of their sister branches down the road, have a truck drive the cash up to the bank. I mean, I cleaned them out. I cleaned the bank out. This was years ago. Long story. I don't need to go into detail. Just know that Junius Maltby once cleaned a bank out. Every depositor, we think we can walk in. They don't have the money. So that's what, bank runs are all about. You've heard of those. We've talked about them. But every banker knows the bank doesn't have that much cash. The bank puts the money out on loan or buys securities. Banks are highly leveraged institutions. So this isn't even just talking about what's in the drawers. They're actually talking about what the leverage that these banks are exposed to. If everyone showed up for the cash at once, there's no way the bank could pay it. That's why the lender of last resort, the Federal Reserve, can just print the money if need be, or type away on a keyboard and digitize it, monetize it, throw it up on a screen. It's no different in the physical gold market, except there is no gold lender of last resort. Gold's a fixed commodity. There's very, very little. The supply of it expands very slowly. Very slowly. Banks sell more gold than they have. If every holder of unallocated gold showed up all at once and said, please give me my gold, there wouldn't be nearly enough to go around. Yet people don't want the physical gold for the most part. It's because they're stupid. They are lazy and they're ignorant and they don't understand why they own it. They just buy it because a chart told them to. Some little financial advisor who took a 1-week crash course in a hotel ballroom somewhere and now is labeled financial advisor and has his little dorky suit and his little comb over or toupee. He said, you might want to allocate 5% towards gold. So they do. That's it. That's the only reason they did it. They don't want to hold it. They think it's dangerous. I think some people think gold's actually radioactive. Or the best is the ones that say, that's too heavy, I don't want to move it around. Hey, look, buddy, I don't want to offend you or anything, but you're not worth enough to call gold heavy. Believe me. Believe me, you're not worth enough. Okay, very few people have enough wealth to dispose of, to put towards gold, to where it would be cumbersome or take up any room at all. Remember, a single London good delivery bar is worth what right now? Let's call it 428 ounces. That single tiny loaf, that one little bar of gold, is worth over $708,000. $750,000 essentially, in just one bar of gold that you could just grab and stuff into a cabinet somewhere in your house. So please do not pretend for a moment that gold is cumbersome to the point where you're going to have a problem with its weight and storage. No. Less than 0.01% of the Earth's population has ever touched, seen, looked at, or possessed a London good delivery bar. And they always claim the same thing, There are risks involved, storage costs, transportation costs, and insurance costs. They're happy to leave the gold in the bank. What they may not realize is that the bank doesn't actually have the gold either. So you're giving somebody money, and they're not giving you anything. I got to get into the gold storage business. I think I'm going to do that. I'm going to start an ETF, start selling paper gold, and then when all these people come for it, I won't exist. I'll be ghost. I'll, have a mansion made of gold somewhere else. Gold holders should expect these games to continue until a fundamental development drives the price to a permanently higher plateau. I hope we are there. Plateau. That's a good Meat Puppets tune. How does the individual investor stand up against such forces? In the short run, you can't beat them. But in the long run, you always will, because these manipulations have a finite life. Eventually, the manipulators run out of physical gold, or a change in inflation expectations leads to price surges even governments cannot control. there is an end game. History shows manipulations can last for a long time, yet always fail in the end. They failed in the 1960s London gold pool, with the United States dumping in the late 70s, in the central bank dumping in the 1990s and the early 2000s. The gold price went relentlessly higher, from $35 per ounce in 1968, when the London gold pool failed, to $1,900 per ounce in 2011, the all-time high, and it will breach that. Price manipulation always fails, and the dollar price of gold will resume its march higher. The other weakness in the manipulation schemes appears in the use of paper gold through leasing, hedge funds, and unallocated gold forwards. These techniques are powerful. Still, any manipulation requires some physical gold. It may not be a lot, perhaps less than 1% of all the paper transactions, yet some physical gold is needed. The physical gold is also rapidly disappearing as more countries are buying it up. That puts a limit on the amount of paper gold transactions that can be implemented. My advice to investors is that it's important to understand the dynamics behind gold pricing. Understanding these dynamics lets you see the end game more clearly and supports the rationale for owning gold even when short-term price movements are adverse. Gold will win in the end. Regards, Jim Rickards for the Daily Reckoning. Thank you, Jim. I applaud you for putting that article together, sharing your experience, your wisdom, and all the things that you've done in the past in regards to gold information and news. I hope the viewers here at the Junius Maltby channel found this information valuable. I like to wait for the middle, towards the end of the videos, for the best information, because only the most dedicated subscribers, viewers, and followers deserve to have any bits or pieces of information like this. So hopefully we lost the the skin tags that tag along and don't really want to be here early on, and the few, the proud, the holders on of the Junius Maltby channel, the most dedicated, stuck it out for the Jim Rickards article, because it was a good one. I enjoyed it. I hope you guys did too. A lot of good information there. I know some of you find the readings quite boring, but this was a piece of information that I believe needed to be spread, shared, and discussed here on the Junius Maltby channel. So there you go. 42 minutes. We're out. Have a good day. Don't forget to like, thumb it up, hit notifications, subscribe, share, be a part of the channel. And as always, thank you to those of you who support the channel. You click the links. You visit me over there on Patreon. You also have shown support in many other areas, and I appreciate each and every one of you who support this channel. There's a steadfast few. There's a few of you that are just really good, ardent supporters. Paladin, Stacker, you're a dear friend. I mean, I gotta say, you're more than just a supporter and a regular subscriber and viewer here. You're a dear friend. Enlightened Patriot, you too have become a dear friend. And there's others, D-Dub, DB. You guys are all good people. Thank you.